Welcome back, everyone. I'm Carol Delay, investment analyst with a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Today, I have two stories. First, the big one. A Chinese lab released Kimi K3, the first open-weight model that genuinely competes with frontier US models. However, within 3 days, it ran out of compute. Within 4, Washington was discussing how to restrict Chinese models, and Beijing was discussing how to stop them from leaving China. I think this is the week the AI nation race came out into the open. So let's unpack what it means. Second, the market. The correction in semiconductors names reached 25 to 40% depending on the name. The bounce has started, and I want to talk about why I still do not fully trust it, and when and where I would be looking for re-entries. Let's dive in. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
Let me start with the model itself. On Thursday last week, Moonshot, one of the Chinese AI labs, released the Kimi K3. It is a huge model, 2.8 trillion parameters, I believe, open weights, meaning anyone can download it and run it on their own hardware, which would be very, very expensive, but still, it is possible. And here's why it matters. On the aggregate benchmarks, this thing sits inside the frontier pack. Not close to the frontier, but at the frontier, next to the best US models. On one popular coding benchmark, it actually came out on top of Fable 5, Anthropic's best model. We have seen strong Chinese models before, but this is the first time an open-weight release from China has landed at genuine frontier parity. That is a real milestone. And of course, the immediate takes roll themselves. Chinese intelligence is frontier and dramatically cheaper, so nobody will keep paying for Claude or ChatGPT. And since it is so efficient, the hyperscalers no longer need all those data centers, so AI capex is finished too. Within a day, both of these were consensus on my timeline. And the chip makers sold off very hard on Friday. I went through the actual numbers, and I posted 2 threads on X during the week, so let me just give you the short version here. Kimi's tokens are cheaper, roughly half the price of the comparable US models, which is already a huge step up relative to previous versions of Chinese models. So Chinese models are getting closer to the frontier on pricing too. Regardless, it burns roughly 3 times more tokens to do the same task. Per task, the independent benchmarks put Kimi at about $1, and the closed American model at matched intelligence at around 60 cents. So Kimi is actually about 2/3 more expensive per unit of WAC and about 3 times slower. Cheaper tokens, more expensive intelligence. Then regarding the build-out of data centers. The model was released on Thursday. On Sunday, Moonshot announced it is pausing new subscriptions out of compute. The demand in the first 48 hours after release came close to the ceiling of their GPU capacity. So they're protecting existing subscribers and letting new users in batch by batch. Think about what that means. The model that was supposed to prove the world needs less compute could not survive 3 days of its own demand. If intelligence just got cheap and abandoned, why is it being rationed? This is the capex worry addressed right there. Efficiency gains do not reduce total compute demand. When usage explodes, they feed it. We have roughly $700 billion of hyperscaler capex guided for this year. The biggest buyers keep telling us they're capacity constrained. And now, the efficient Chinese challenger is literally rationing access because it cannot serve its own demand. So the easiest conclusion from the Kimi K3 release is that the world will need more compute, not less. On Monday, the news broke that Washington is reviving the push to restrict Chinese AI models in the US. Reportedly on the table, putting Chinese labs on the entity list, banning Chinese models from the federal procurement security advisories, even liability rules for American companies that host Chinese models. The US government is trying to find ways to softly restrict access to Chinese model. Soft, for now. And here's the mirror image, which I find even more telling. Beijing, reportedly, has been consulting its own champions, Alibaba, ByteDance, the big labs, about restricting things from their side. Whether foreigners should keep being able to freely download Chinese model weights at all, and whether training data should be allowed to leave the country. Access through the cloud would stay, so the world could keep renting Chinese intelligence. It might just not be able to own it anymore. Both sides, the US and China, are converging on the same conclusion from opposite directions. So, where is all of this going? I think the conclusion writes itself. This is now openly a nation race. The way the space or nuclear race was a nation race. The frontier is no longer an American monopoly, and both governments just told us in the same week that they consider frontier models strategic national assets. From here, I think it only gets worse, or more intense if you prefer. More curbs from both sides, on models, on chips, on data, and much more government involvement and government money in the build-out, because neither side can afford to lose the lead. The direction for the infrastructure spend is up. Compute, power, the whole supply chain behind it. Governments do not run austerity programs in an arms race. And China spent this week proving the point with actual money. Chinese tech stocks get hit by the same unwind. The Star 50 index was down 17% in the week, and the state stepped in. On Sunday, state platforms deployed more than $8 billion into tech assets. On Monday, the national team put a record $2 billion into the Star 50 ETF, the Semiconductor and Innovation Index. On Tuesday, the Star 50 jumped 11%, its biggest day in 2 years. Beijing is treating a correction in its AI complex as a systemic risk and defending it with the state money. And Washington made its own move on the money front the same week. The White House put out a blueprint redirecting the federal research enterprise, roughly $200 billion a year, away from the universities and toward AI, framed openly as a race with China. So, we have different tools, but same direction. State money following strategic technology. Let's move to the market now and start with the damage report, because the numbers are big. In semiconductors, the correction we have seen over the last weeks run 25 to 40% depending on the name. Marvell down 40% from its June high. Micron down 30 in roughly 3 weeks. Broadcom down 25%. The semiconductor index itself down 23%. And this happened fast, the bulk of it inside a few weeks. Now, if you have been with this channel for a while, you know we exited our semiconductor positions at the start of July. That was the right call. And honestly, even I did not expect the correction to be this sharp and this fast. This was a very violent unwind. And the speed is the tell that it was a positioning, leverage coming out, coupled with some wrong conclusions on the fundamental side. There was a funny stat disclosed by the Korean regulator. 3.5% of working age adults, roughly 1 in 30, have been notified about margin calls of the last weeks. Koreans just love leverage, I guess, and it has its spillover effects. Mainland China, by the way, saw the same thing. Leverage positions unwound at the fastest pace since the 2015 crash. So, I guess, yes, everyone needs to be careful with leverage. And that speed also shapes what I expect next. After a move this deep and this fast, it is difficult for me to expect much more downside from here. Could we get another leg? Yes, of course, it is possible. But history is on the side of the correction being mostly done. And I want to show you why. This is NVIDIA, the poster child of the structural bull market, with every meaningful correction of the last decade marked here. We run this study across 7 of the great structural winners, 2 decades of data, well over 100 corrections, and the pattern is remarkably consistent. Inside a structural bull market, corrections of 25 to 35% are normal. Every single correction up to about 35% deep resolved at a new all-time highs, and usually within months. The ones that went meaningfully deeper were the real breaks or happened during bear markets, and they behaved completely differently. They took years to recover. So when I look at this correction, single semi names down 25 to 40, the index down 23, NVIDIA itself down 18, this sits squarely in the historical range of a healthy pause inside the intact trend. Outside of a bear market, this is what normal looks like for these names. And the fundamentals agree the trend is intact. A couple of episodes ago, I talked about Micron and Samsung earnings that were extraordinary. We got TSMC and ASML reporting spectacular numbers last week, which the market did not care about at all, but they were very good. Also, broadly speaking, we're 2 weeks into earnings season. Only about a tenth of the index has reported so far, and it's close to flawless. Almost 90% of reporters are beating earnings estimates, and not by a little. On average, earnings are coming in 16% above expectations, more than double the normal surprise. Blended earnings growth is running at 25%. Revenue growth is the highest in 4 years. JP Morgan just printed the most profitable quarter of any American bank in history. Goldman Sachs nearly doubled earnings per share year over year. And the JP Morgan CEO described the environment as close to as good as it gets. So that is the flaw under this market. The businesses are fine, better than fine. So earnings are excellent so far. The correction already did historical sufficient damage, and the market bounced hard on Tuesday. Micron up 11% in a single session. So why I'm not chasing this bounce? Because the backdrop it is bouncing into is not supportive in my view, and I want to be clear about that. 3 things. First, oil. WTI has gone up every single day since the middle of last week, and it's sitting in the mid-80s, the highest level since the acute phase of the war. So, not an extremely challenging level for inflation, but still it's not going down. And the president is not in the mood to de-escalate, it seems. Second, rates. The 10-year is back at 4.63. All of the relief from the soft June inflation print has been unwound, and real yields are firm. Again, due to oil and risks that inflation will come back, which I do not believe will happen, but still, the setup is not screaming risk on right now. Equities rallying on Monday and Tuesday while oil and real rates climb is divergence, and divergences like that usually resolve in favor of the bond market. So we need to be patient, I guess, here. Third, the technicals. We talked last episodes about the correlation in the market, that the index level looks fine, but stocks are not really moving together. That has not been resolved at all. So the bounce is real, but the fundamentals underneath it are not there yet. The market is still fragile underneath, and I think the rotation we have been talking about is ongoing and will continue over the next weeks, maybe even months. And there is one more reason to stay patient. The Fed meets Wednesday next week. The meeting can change this picture in either direction, but probably won't, because it is a July meeting right before the summer break with no projections and the war restarted. I guess the governors will not say much new, even though inflation was good in June. The next big event, I think, from the policy perspective, will be Jackson Hole in late August. So, the plan. I said we exited semis at the start of July. I also said the correction has now done roughly the historical amount of damage. So, for those of you who want exposure to this space, and I'm one of them, I think the window to start looking for entries is opening, and it will last until summer is over. Not chasing green candles on bounce days, but using the choppiness or wobbliness I expect over the next few weeks to build positions in the quality I names. The only risk in not doing it fast is that the government intervention, like the one the Chinese just did, gets broader and stronger. In this case, you really want to be in the trade no matter the cost. No. Monitor that. The scoreboard. Nothing changed versus last week. We are positioned rather defensively. Notably, there was some rebound in metals this week. Anyway, you can see everything on the table on the screen. Let me pull together. Story 1. China put an open weight model on the frontier. It ran out of compute in 3 days, and within a week, both Washington and Beijing were working out how to control the technology. The AI nation race is now official policy on both sides. And that means more curbs, more government money, and bigger build-out. Beijing wrote the fast check this week. The infrastructure trade is not ending. It is getting a second buyer. Story 2. The semis correction has done the historical amount of damage. The earnings floor and more demand from China are real. But with oil grinding higher and real rates firm, I'm not chasing these bounce yet. I'm using the summer chop to accumulate the quality names. For the timely calls in between these videos, follow me on X. It is linked below. And that's it, guys. If you got something out of it, hit subscribe, like, and I see you next week.